here at the New Orleans Investment Conference and catching up with Danielle DiMartino booth. Danielle, the last time I saw you was just after a Fed meeting. Here we are again, just after a Fed meeting. I'm not a fan of Fed meetings per se, but if I get to interview you every time after us, I think it's a pretty good trade-off. How are you?
I love it. Good to see you again.
You mentioned in your talk that a talk you did here 2 years ago. You called it the white dress talk. This is a red dress talk.
Yep.
In your opinion, what is the main difference between the state of the economy, state of banking, state of overall health of the economy versus today, 2 years later?
Well, I think that the economy has definitely slowed in the last 2 years. I think there's an abundance of evidence to that fact. 2 years ago, we were kind of coming off of Hurricane Harvey, and that pulled the U.S. auto industry out of recession. I don't think people understand the import of that. And then we have the tax bill work its way through the economy. That was another event that propelled the economy forward one more step. And then this was followed by the threat of tariffs, and that pulled a lot of demand forward as well. So we've gotten a lot of juice out of the economy. We've been able to extend the cycle for much longer than logic would dictate because of these three massive economic events that hit the economy. But here we are today with the trade war slowing the economy more than it otherwise would be, with what it looks to be the auto industry going back into recession and the Federal Reserve backpedaling, trying to make interest rate sensitive sectors react to easier monetary policy, ... again, and we're blowing up the balance sheet.
Right, so to reference your old colleague, Richard Fisher, pulling growth in. So taking the forward growth, pulling it in. That's what we did before. We're running out of places to pull that from, aren't we? If you look at China, if you look at the rest of the world, India is not going to fill that gap. So what do you see them trying next?
It's hard to say. It's pretty apparent that we're going to continue, that the Federal Reserve is going to continue to grow its balance sheet. If you look at how much it's already grown its balance sheet, it's at a $1.6 trillion annualized run rate, and I don't see Jay Powell stopping anytime soon. I think he's going to crank up the money printing as much as he needs to try and forestall any kind of a credit event that seeps its way into the financial markets, because then it's game over for the U.S. economy.
Yeah, so a bit of an oxymoron. Hawkish cut. Is that like those heart-healthy beignets I had this morning? What do they mean by hawkish cut, and are they going to stick with that?
I think they want to stick with a hawkish cut. I truly think that Jay Powell is sincere in saying he does not want to impose negative interest rates in the United States. And there's also a matter of optics right now. They want to have it appear as it was a Greenspan-esque 1995 or 1998 event where you could do 3 interest rate cuts and have the economy continue to expand, have the markets continue to rally. And I think that that's what he wants for the community at large and and investors to believe. But we're supposed to just disregard the massive amount of not quantitative easing, because he won't call it quantitative easing, that's going on in the background in order to prop this up.
Right, so we all had a bit of a lesson, at least I did, an overnight paper not too long ago.
Please don't say repo. Oh.
Yeah, right?
Exactly.
Repo Crisis. The liquidity that we thought was there, or at least the liquidity that the Fed thought was there, was not. It was like having a bucket of water. Really, it's a bucket of ice. It doesn't move.
Well,
so what happened there?
I think about this as being actually a bucket with holes in it. So the Fed can obviously not control the overnight lending market. In addition to quantitative tightening, there was a huge increase in currency in circulation. And in addition to that, you've got foreign central banks parking money here in the United States at the Federal Reserve because they've got negative interest rates in their home countries and they're looking for a higher yield. So you effectively pulled double the amount of reserves out of the system as what quantitative tightening was in and of itself. And the Fed surely should have seen what was coming, because it's, quarterly tax payments aren't any mystery. And we knew that the Treasury was going to dramatically increase the amount of borrowing after the debt ceiling after we got through the debt ceiling. So the Fed should have known what was coming. This should not have been such a shock.
Yeah, and that last point, that's not talked about much, and that is the increased demands that Treasury is putting on credit. How big of a factor is that?
Well, it's enormous, because think about the Treasury having a checking account at the Fed. It's the most simplistic way I can put it. That checking account was approaching overdraft. So, we absolutely had to rectify that situation. But once we did, we had to build the balance back up. And in the meantime, we're running $1 trillion deficits. all of which has to be financed. So this has been an extraordinary period for U.S. sovereign borrowing, but it's also something that was on paper. It was on a spreadsheet somewhere at the Fed, and somebody should have seen it coming.
All right, last question. One pundit I listened to said that the liquidity trouble we saw in repo is indicative of perhaps liquidity trouble everywhere in the debt market, corporates as well. How serious is that?
So I'm asked on Twitter constantly to speculate on this very question, and my stock answer is I have no idea. We don't know, and we cannot know about whether or not there's going to be contagion into the credit markets. What we do know is that you cannot have overnight lending rates spike to 8% or 10% and not have a knock-on effect in the credit markets, and I think that Jay Powell knows that. To the extent that we see overnight liquidity ramp up maybe beyond $120 billion a day, I think the higher that number gets, the more evidence that we have accumulate that there could be something else going on that's not simply a technical matter, as Jay Powell maintains.
Right, and even if we didn't have a problem, wouldn't you say that the event that we had is going to put an increased premium or demand on liquidity going forward, and that could exacerbate any problems?
Of course it will, and I think the banks know it. And now the banks are, there might have been speculation about how willing Jay Powell was to crank up the money printing machine. Banks have got his number now. They know that he's going to print as much as he needs to alleviate any stresses.
All right, thanks very much for stopping by.
Thank you.